A seismic shift is underway within the UK insurance sector. A recent landmark survey has revealed 89% of UK insurers have now adopted digital tools or artificial intelligence in their core operations. This number is more than a mere statistic. It is a clear declaration the industry has crossed a significant threshold. The era of speculative pilots and tentative experiments with AI is officially over. We are now firmly in the age of implementation, where digital intelligence is becoming as fundamental to insurance as shared risk itself. This is significant news today, October 28, 2025, because AI is moving from a competitive advantage for a few to a baseline necessity for all. The speed of this adoption is what makes this moment critical. What was once the domain of forward-thinking tech teams and innovation labs has now permeated the entire business structure. This is not just about a few new software programs. It is about a fundamental rethinking of how insurance works from the ground up. The implications are profound and far-reaching. They touch every aspect of the value chain, complex actuarial tables used to calculate risk to the very first interaction a customer has when requesting a quote. The 89% figure signals the industry is moving in concert, driven by efficiency, customer demand, competitive survival in a data-rich world. This rapid digitalization is altering the competitive landscape. Momentum pulls the market along. For the remaining 11%, adapt or risk obsolescence. The story is no longer whether to adopt AI, but how to manage the opportunities and the inherent risks. For centuries, the science of insurance has been built on the foundation of actuarial tables and historical data. Traditional risk models were masterpieces of statistical analysis, but they were inherently static. These models were powerful, yet they had their limits. They relied on structured history and broad categories, a blunt instrument for a nuanced reality. Old methods were slow to update and could not digest our digital torrent of data. Artificial intelligence introduces a completely new paradigm. AI-driven risk models are dynamic, adaptive, and can process vastly broader information. Instead of relying solely on past claims data, these models can ingest unstructured data in real time. Satellite imagery, telematics, engineering reports, social sentiment. They interpret the present to predict the future with far greater precision, a process of constant evolution. Flood models now auto-adjust on forecasts, river levels, and new development, a granular, perpetually updated view of risk. Where proxies once stood, AI measures behavior and conditions directly, individualized driver risk and property risk in near real time. This shift from static averages to dynamic assessment is the greatest change in underwriting. Once science fiction, now standard practice. The introduction of AI is fundamentally rewriting the rules of underwriting and pricing. Insurers can move beyond broad pools toward hyper-personalization, dynamic pricing reflecting unique risk profiles. Safe drivers tracked by telematics can see significantly lower premiums, a direct incentive for risk-reducing behavior. Home IoT that prevents loss is reflected in insurance cost. AI can digest thousands of data points, financials, supply chains, cybersecurity, generating precise quotes in minutes. Automation slashes admin and shifts underwriters from data processors to risk strategists. Claims are transformed, triage, verification, fraud checks, simple claims settled in seconds, boosting satisfaction and consistency. Data-driven assessment catches anomalies and fraud, while legitimate claimants receive fair, consistent outcomes. AI is reshaping the customer-facing side of insurance. Chatbots and virtual assistants handle routine queries, quotes, coverage explanations, updates, and claim status. Always on. Automation frees human agents for intricate, empathetic work when it matters most. AI anticipates needs, turning insurance from reactive transactions into proactive support. A seamless journey across channels without repeating information. AI keeps records synchronized, reducing friction and effort. Insurance becomes an integrated part of digital life. Better speed, personalization, and convenience increase loyalty and retention in a competitive market. The widespread adoption of AI in insurance brings complex challenges: ethics, regulation, the workforce. If models learn from biased history, they can amplify it, risking digital redlining and unfair premiums. Regulators and insurers must ensure fairness and ethical and legal responsibility. Opaque models challenge explainability. Decisions must be understood, not the algorithm decided. XAI provides clear justifications, sustaining accountability and trust. Repetitive roles decline while demand surges for data scientists, AI specialists, ML engineers, and governance experts. The transition must be managed with serious investment in reskilling and upskilling. Custodians of sensitive data must embed privacy by design and robust cybersecurity. Trust depends on it. The ripple effect and the implications for UK and Canadian finance. Insurance is a cornerstone. Its digitization pressures banks and others to match speed and personalization. Adoption accelerates across lending, wealth, and fraud detection. Demand for specialized AI, secure cloud, and analytics spurs vibrant tech ecosystems and jobs. Validation, bias detection, and explainability vendors become critical partners. Standards for data sharing and security emerge. With shared ties, Canadian insurers track UK advances. Regulators like OSFI, PRA, and FCA learn from each other. As UK frameworks mature on fairness, transparency, accountability, similar principles will shape Canada, including data flow rules. The UK's experience is setting signals for AI governance in finance worldwide. The double-edged sword, quantifying benefits and managing risks. Automation reduces overhead, errors, and cycle times, saving costs to reinvest or pass on as lower premiums. Better fraud detection saves the industry billions, strengthening sustainability. Faster, personalized, convenient service and action-based pricing feel fairer than demographic proxies. But bias, opacity, and cyber threats can trigger exclusion, legal exposure, and reputational damage. Mitigation demands rigorous testing, continuous monitoring, transparent governance, and robust cybersecurity. Insurers need a top-led AI strategy, human-in-the-loop controls, data governance, security by design, and staff reskilling. Regulators must balance innovation with fairness, transparency, and accountability. With 89% adoption, AI is now the operational standard, delivering accuracy, speed, and personalization. The journey has just begun. By pairing ambition with principled caution, we can build a fairer, faster, more effective insurance system for everyone.